everyone, and welcome to our YouTube channel, Moneyline with Nancy at TV. In case you're not a subscriber yet, please do subscribe. Just press the subscribe button as well as turn on the notification bell so that you can get notifications when we upload our videos. Don't also forget to subscribe and join, follow, like our other social media platforms. Of course, you're seeing it right about now. Don't also forget to share this video across your platforms. Enjoy the video. All right, welcome back to the program. My guest is joining me right now, Tajudeen Olayinka. He's the Chief Executive Officer at Wyoming Capital and Partners. Mr. Olayinka, welcome to the program.
Good morning, Nancy.
Good morning, sir. Let's get started. This August inflation data coming in, the prints are coming in at 20.12%. Is that real?
Well, I want to believe it is real. It is real in the sense that since CPI was rebased, and we've had this trend, except for the January inflation number. Subsequent data that were released by MBS suggests that what we are seeing currently is what we are also going to be seeing going forward. Now, if you look at what gave rise to this high inflation that we have witnessed, over the let me even say over the past 3 to 4 years now, since the regime of late President Muhammadu Buhari, is something that you cannot take away from the policies of government. The moment President Tinubu decided to remove fuel subsidy and of course float the naira. Naturally, we expect this kind of high inflation number to be around with us. But the subsequent, the short-term policies that they have put in place, to actually ameliorate the situation, such as this special import, import program that they have put in place, is actually responsible for the decline in inflation rate. So we are going to see this kind of trend going forward for as long as that short-term measures are still there. Waiver of duty for some food items. Especially those basic food items that they are bringing from abroad. So if they continue with that with that measure, definitely we are going to see this downward trend in inflation. Don't forget the major thing that will permanently resolve inflation problem is for government to run a comprehensive supply side policies and programs that are long-term in nature, not short-term in nature. The one they are running currently is actually short-term intervention, and I believe that the long-term aspect is also being worked upon by government. It's a good development. It's an indication that. Okay, let me listen to you.
Okay, so you're of the view that, of course, we're seeing short-term interventions, and that's what's making inflation. That's why we're seeing this inflation. But exactly. The numbers are still high, and Nigerians should not be jinxed to think, okay, exactly. Now that is at 20.12%, that means that things are getting better, as it were. The rate of rise is slower, and there's a difference between this inflation and deflation. I needed to put that in so that people don't get it misconstrued.
That's right.
Are you saying, Mr. Olayinka, that perhaps is the base year change that is impacting this, alongside with the short-term intervention of the federal government? And what short-term intervention do you even mean? Was it sometime last year or early this year that the federal government said opened, I think, 180 days for imports of rice? I don't know if that has elapsed, and you can actually also justify why the price, for example, because a lot of people say a bag of rice has come down 50 kg, selling at about 70,000, even less than that. So what do you have to say about the structural shift? Because you actually said earlier that government is working on the long-term measures. What long-term measures do you expect the government to work on, which I assume should be the structural intervention?
Of course, the long-term measures will obviously be the structural issues that are still holding the economy down. And the more they are able to address those issues, and they are largely in the supply side of the economy, there are those all these supply side factors that they actually have to deal with. And when you look at some of the programs, especially trying to get tractors for farmers, even at state level, we have seen demonstration of that interest by some state government where they are now trying to get tractors for farmers, trying to improve, farming method and things that will, make farmers to actually operate, on the large scale. So some of these measures are actually long-term in nature, and some of these measures are actually meant to boost the supply side of the economy. So once we improve the supply side factors, of course, we are going to see improve inflation number. The inflation number will actually come down. What we have today is still elevated, because if you compare it to 29-year average, it's still higher than that. So that suggests that we are still not there, because I think 29-year average is about 14 point something percent. So if you are still above 20%, it means that you are still far away from the 29-year average. So until we get back to that 29-year average, government cannot rest on its oars. So they still have a lot to do in terms of structural shift and what I will call long-run adjustment measures.
With food inflation, the data telling us that it's cooling off a bit, but it's still elevated, however that you look at it. How much of the supply side shocks can the government avert, perhaps with some of the interventions that you expect?
Okay, I think, because like I mentioned earlier, the measures that are actually making us to see improve inflation numbers is actually coming from some of these short-term measures that they have taken. They started that since last year, and we are seeing that improvement. They also, don't forget also that because of the fact that they are able to, we are beginning to see improvement in foreign reserve, improvement coming from largely foreign portfolio inflow. Investors coming from abroad, or even local investors that are actually having offshore funds, bringing back their funds to actually participate in the fixed income market, and of course in the equity market as well. So all these activities are helping to actually provide liquidity in the FX market. So that liquidity improvement is what is actually creating stability in that market. And once we continue to have that kind of stability, of course, with other measures that the government has put in place, you definitely continue to have this inflation, this inflationary trend that we are currently witnessing. So I want to believe that they are not going to stop that measure for the time being, because those measures are very important, and because those measures are meant to actually improve the supply side of the economy, they can't take them off until we have much more stability.
So if, with what you're saying, do you now think, or should we now conclude to say that what government is doing to bring down this inflation rate from the 30s, the upper 30s that we saw in 2024 is cosmetic, as it were, without no solid foundation? It's cosmetic in a way. Okay, Nigerians have cried so much because of fuel subsidy removal, and we've seen the inflation trend from 2023 that president came in to December 2024, and the government just needed to give us something not to complain about. Remember, there was a protest last year. I think it was the End Bad Governance protest, hunger protest and all of that. So do you think that with what the government is doing now is seemingly cosmetic, like putting foundation on a face?
Okay, Nancy,
and going and saying, okay, macroeconomy, things are improving. That was why I asked the first question, if this inflation data that we're seeing is real.
Okay, it's real, and I wouldn't want to use the word cosmetic, because you only say it's cosmetic if the short-term measures that they are put in place are not also supported by long-term measures that they are also working on. They are basically working on so many things. Don't forget, before this government came into office, I think I appeared in your program and I said to you that this particular president and the two other candidates that were contesting that election with him were going to run, were pro-market in nature. And of course, except for two of the other two that did not have the opportunity to be in power today, who are now saying that they are not so much supportive of what the current president is doing. But the truth is that all of them were going to run this kind of policies, because those things that they promised that time would definitely bring up this kind of pain. There's no way you remove subsidy and you won't have this kind of problem. There's no way you unify the exchange rate that you won't have this kind of problem. So they are normal, the inflationary trend that we have seen over the years, especially since the coming of President Bola Ahmed Tinubu, are the usual pain, are the usual inflationary trend that you will see when the government is running adjustment policy. What they are running is adjustment, trying to realign the economy, try to put the economy, in the right shape. The economy was in the right shape when it took over, and so in the course of implementing measures that will right the wrong, that will put the economy in the right perspective. But definitely you have to run adjustment program, and when you are running adjustment program, it comes with pain. Those pains are just natural and they are normal. You cannot escape them. Even those other two candidates who said that they are not happy with what is happening, there was, I don't think there's anything they could have done differently. Because once you have this kind of situation that President Bola Ahmed inherited from late President Muhammadu Buhari, definitely you have to run adjustment program. And those short-term adjustment issues are what is bringing those pain. They are the usual pain that you see in the short run when you are running adjustment. They are short run adjustment. We call them short run adjustment pain. So once you have that, and then you are also coming up with long-term measures, both on the supply side and of course even on your fiscal measures, you are taking measures that will right that wrong, and of course that will improve the long-term perspective of the economy. So in the long run, we are likely to see much more improvement as all these economic agents adjust to the reality of what we have currently, to the reality of the true status of the economy. So I wouldn't want to say it's cosmetic in the sense that they are also taking measures that will put the economy in the right perspective in the long run.
Mr. Olayinka, the MPC meeting will be in a few days. How much room do you think that the CBN's MPC do have to balance inflation targeting and growth support at this juncture? Do you think that they will still pause, or they will lower? There are no arguments as to raise interest rates because they've paused it, I think, the last few meetings. So what do you think?
Okay. First and foremost, let's try and understand, the reason for CBN position. In the first instance, how did we get to that, high interest rate regime? They needed to attract foreign portfolio inflow. They needed to make the government issuance program more, especially government securities, more competitive with those that are issued by foreign governments, elsewhere. And so the idea of a high interest rate regime came from the fact that they wanted to create stability in the foreign exchange market by stimulating inflow from foreign portfolio investors. So foreign portfolio investors came in large growth to actually participate in our market, to take advantage of high interest rate regime in Nigeria. And of course, for that reason, we have continued to see stability in the foreign exchange market. So that if you understand that fact, it is unlikely that CBN will want to do things that will actually bring interest rate down for now. But I want to believe that the interest rate naturally should go down by market dictates, and we are beginning to see semblance of that, where investors are actually asking for a lower yield that are lower than MPR. So if you continue to witness that trend, then MPC might not have option than to now begin to moderate the MPR to a level where it can actually support the real economy, where it can actually still be able to attract this important foreign portfolio inflow. So long that we still need those money to be with us, central bank may not. They may be just a slight moderation, but I don't think they will go a whole hog, pushing that MPR down so strongly. But there could be a moderation, or see they may still want to hold. But what I suspect they want to achieve is a situation where the market itself will adjust the interest rate on its own, and then the CBN will now use we now have no option than to adjust its own MPR to a level where it can meet the true commercial rate in the market. I believe investors on their own can bring that interest rate if government continue on this current trend.
What rate do you expect, and how do you expect investors to bring down rates on their own?
Well, the only way they can do that is when we come to see this inflow. Once the demand is higher than supply, of course, they definitely will see moderation in the interest rate. We are beginning to see a semblance of that. That's why you see perhaps all the yields are below MPR, which means that definitely investors they are comfortable with the rate they are getting currently, and they don't forget the kind of signal we are seeing in the equity market is an indication that they also believe that interest rate will eventually go down, not necessarily by MPR moderation by CBN, but by investors actually taking position in both markets and causing interest rate to go down to a level where it can actually be very, very close to what we have as inflation rate. So investors will do that once we're going to see large influx of funds from foreign portfolio investors and local investors also participating in the market. Those are the things that will bring that interest rate. It's the demand. Once the demand is huge from the buy side, of course, definitely we'll see moderation in interest rate. And of course, we also expect that CBN should moderate their issuance program, especially the supply side of the market, by not just unnecessarily increasing the volume that they put into the market. Those are the things that will cause inflation. Will cause the interest rate to moderate, and of course, we'll see improvement in the equity market.
What rates do you expect when they meet next? When they meet in a few days, should that be next week also? But just in a few days.
It's next week. Yes, I think it's next.
Yes. What do you expect? What rates?
I'm thinking that between 25 basis points and 50 basis points might be a starting point for MPR moderation by central bank.
So you are within 25 to 50?
To 50, yes, 50 basis points.
And it's currently at 27.5.
Exactly. So if they remove 50 basis points, that takes us back to 27. Yes, exactly.
But if they remove 25, that's 27.25.
It's just to show to
signal to the market that.
To the market that yes.
That they also see what is happening. Yes.
Exactly. But not that they want to push the interest rates on their own. They want the market to actually adjust interest rate itself, and that is very possible.
What if the CBN's MPC is not attentive and they play deaf ears to what the markets are saying and what everyone expects of them? Because in last few meetings, a lot has also been said, okay, this is time for you to moderate, to bring down your rates, yet nothing is done. What if the MPC doesn't listen to all of this and they perhaps have superior data than the rest of us and say, we are still waiting to see, let's just perch, let's wait on the fence and we're looking. Don't forget that 2026 is a pre-election year, and things will begin, dollars will begin to fly up and down. So what if they disappoint markets or even analysts and just still hold it?
Okay. Yeah. Well, I don't think I don't even want to sit at disappointed. You have used the right word. If they have much better data that we don't have, but I think the data that is out there suggests that what CBN is doing is deliberate, and what they want to encourage is a situation where the market will on its own bring down that interest rate, force the yield down through their own activities, through the interaction between the supply and demand side of the market. So obviously, once we begin to see that, I think they are very likely to do that 25 to 50 basis point adjustments, just to have some kind of moderation, just to signal to market that yes, we are what is going on, and I will think that since market is also trying to dictate the pace, we will align with the market. I think they want to align with the market. Not that not they don't want to force the interest rate on the market, but they want to align with what market is actually asking for. And eventually, in the coming months, in fact, in the fourth quarter, we are likely to see that. You see that inflation from the market itself. So once that happens, CBN will have no choice than to further moderate the MPR.
Do you see or do you anticipate this disinflation, the continuing disinflation that we're seeing, encouraging greater participation in the equities market? The year-to-date return stands at around 37%. How do you see this moving forward as we are coasting towards the end of the year? In fact, we are getting towards the last quarter of this year, and the market has not done badly, though. It's still higher than inflation rates there, so positive real rates there.
Okay, I said it earlier that equity market is actually responding to what the future interest rate will be. Even though interest rate has not completely moderated, but they hope that the interest rate will moderate. And once interest rate moderate, then we will begin to see some kind of improvement, or some kind of the kind of rally we are currently seeing. We're going to see more of that. So I want to believe that whichever way you look at it, both ways, we will continue to see improvement in the equity market. We will see rally, then we'll see profit taking that we witnessed in the last few days, the last few trading sessions.
Mr. Olayinka, with consumer spending power still under pressure, do you still see gains in the market moving forward towards the end of the year? Do you think that you're still going to get that in investors' interest? Consumer spending, and I would like you to give me the ratio between foreign investors and retail investors' participation now, because sometimes it oscillates.
Yeah, it's still not at the level we should have it. We've only seen improvement in the foreign participation in the equity market, but they are largely present in the fixed income space. So, and they are doing well there. So if you don't have them in equity, you can have them in fixed income. And the moment you now begin to see more of them in the equity market, it means that you have seen total moderation in interest rates, and for that reason, they will embrace the equity market, also helping to push up prices. But the critical thing we must understand that the stability in the foreign exchange in the exchange rate, and especially the liquidity in the foreign exchange market, has made it possible for public companies to actually improve on their on the cost that they incur in terms of output. So once we continue to see improvement in cost, and they are passing that same improvement to consumers, we will continue to see improvement in their bottom line, and then we continue to see more consumers patronizing this local this local product that are produced by this
okay, Mr. Olayinka, let me put this in, or let me re-ask my question. With consumer spending under pressure, do you still see gains in the consumer goods space? Then with disinflation happening, the FMCG space, how do you think that they will cope?
That's what I'm saying. Well, that's what I'm trying to put across to to the audience. The issue is that once you have moderation in inflation rates, it's going down at the level that we are seeing currently. Definitely, there will be improvement in purchasing power. And don't forget also that even though the minimum wage is 70,000 naira or thereabout, you hardly will see any companies that, or any real sector business that is actually paying at that level. From time to time, they also, as they have improvement in their cost pressure, they definitely will also want to improve on what they pay to their own employees as well. And so that improvement we now go beyond the company specific or industry specific to other sectors of the economy. And so the moment we're going to see that, yes, it's still under consumers spending or consumer purchasing power is still under pressure, but it's not at the level we used to see it in 2023 and of course in 2024. So if you look at what we experienced in the past in almost the past 2 years, then obviously what you are seeing currently means that it's still under pressure. The consumer spend is still under pressure, but it's not as thick as we witnessed in the past years.
Do you think that the companies would make gains moving forward? Those companies in the consumer goods space, do you think that this will translate to more gains for them? Because even those in that space, in the companies in those spaces have sachetized everything. You understand?
I understand.
Yeah.
See, but let's look at it this way, Nancy. You see that even if you look at the results, the third quarter, the half-year results, the third quarter results for some of these companies, you see clearly that the issue of foreign exchange losses has almost been put behind them. And so once, like I said earlier, once we continue to see the kind of stability we are witnessing in the foreign exchange market, especially in the exchange rate, then we continue to see improvement in their bottom line. We'll see the companies will likely move away from things that will make them to report foreign exchange losses. At least we are seeing almost all across board. We are seeing moderation in foreign exchange losses that they used to declare. And so once we see that improvement, look at Nigerian Brewery, for instance, look at MTN, look at several other companies in the consumer goods sectors. So basically, we are going to see improvement, and that improvement will mean more gains for more gains for these companies and more gains for shareholders. Good earnings, good bottom line for everybody.
How about the pricing? Do you think that we could see a likely correction soon concerning pricing and repricing of some of these equities?
Yeah, you don't forget we had the ASI touching almost 145,000 or even above that or so recently, and it moderated again to below 140,000. Yesterday it was about 141,000 plus. So what we see is the pricing is coming from the fact that we are seeing improvement in the performance of some of these companies, and we are also seeing stability in the macroeconomic environment. The stability in the macroeconomic environment is what is causing the pricing in both markets, whether it's the fixed income space or in the equity market, and even in the real estate market, we are seeing total repricing. And so when you talk about price correction, we saw a bit of that when the ASI was just a little above 145,000 index points. So the repricing will continue to take place. The price correction will continue to take place so long bullish sentiment or the rally in the market is causing overshooting. Anytime you have overshooting, there must be price correction. And so overshooting of the last few weeks was what was responsible for the price correction we saw that brought the index ASI, that is all share index, to below 140,000 index points recently. And there is now beginning to rally up again, to ramp up to a level where it is now above 140,000. We will see moderation, but we will not see a total push unless interest rate comes down to a level where, say, for instance, if you have interest rate if you have a yield at about 10% or say 12%, then definitely we will have much more improvement in pricing, at the equity market. We see a total repricing across board.
With the banking recapitalization deadline looming soon, March 2026, we've seen a few of the banks meet the recap thresholds. What should investors be looking out for, even as we approach towards the end of the year, and what is your outlook moving forward? We have, after this MPC in September, we have another MPC meeting in November, so you can coalesce everything, summarize, and let's just know what we are to expect in just a minute or so.
Okay, yes. Obviously, we are going to see, how best do I put it? Can you please just quickly rephrase the first question? I think I missed that one somehow.
Yeah, what I'm asking is, looking ahead, what should investors expect as we move towards the end of the year? There's one MPC looming in a few days, another MPC in November, and as we move towards 2026, don't also forget that the bank's recap plans are on the way, just a few months to the deadline in March 2026.
Okay, yeah, investors will expect something positive, and we are already seeing that. I think from both markets, we are going to see some positive outcome. Those who did not participate in the initial public, in the public offerings of some of those banks, definitely know that they have actually missed out, because the subsequent rally after those issuance program by those banks suggests that any offering or any offer from any of these banks in the coming months or in the coming weeks will definitely attract investors' interest. Investors will actually pay attention there to be able to have more gains in the future. Seeing clearly that even when GTB issue his own shares at the price he did, and then not many investors, actually not many strong investors embraced it because of some of the issues that they had at that time. And we saw little investors, taking strong hold of that particular offer. And the subsequent offer, GTCO had to go, had to go for foreign listing to be able to achieve more institutional investors' participation. So all these things should suggest that investors generally should expect more positive outcome in the market, both in the fixed income space and the equity market going forward. We are going to see an interesting market, and I believe all the banks will be able to meet that deadline, especially either through mergers and acquisition or through more public offering. You saw Wema Bank, meeting that threshold recently with their last offering. Yes, with their last offering. So we are going to see more of that going forward. Any bank that comes out now will surely be able to sell whatever they have in the market.
Okay, thank you very much, Mr. Olayinka, for your insights, as always. Do have a lovely day. Thank you again.
Yeah, it's always my pleasure. Thank you, Nancy. I appreciate it. Thank you.
You're welcome. All right, I've been speaking with Tajudeen Olayinka, who is the Chief Executive Officer of Wyoming Capital and Partners. We've been looking at the August inflation data as it relates to other markets, as well as the forthcoming MPC meeting in a few days, what you're to expect. All right, that's the much we can take on today's edition of the program. Thank you for your company. As always, be the best you can be and be the change that you want to see. I am Nancy Naji. Bye for now. Thank you for making it up to this minute, watching the video. Thank you all. Don't forget to subscribe to our YouTube channel, Moneyline with Nancy TV. Like, follow all our other social media platforms where we keep you up to speed with fantastic interviews, as well as markets, personal finance, business, and economy information. This is the best place to be. I'll see you all again in the next video.